Everyone wants to know, what should I do with my student loans? I recently gave a talk to the Latino Medical Student Association. There was a line of students who wanted to know the answer to this question. Should I stay with IBR? Should I stay in the safe forbearance? Or should I enroll in RAP? Apply principles of debt management to understand your student loans. How many people have student loans? All right, so we're on target. So if you are a medical student, a resident, or early in your career as a healthcare professional and still have student loans, then this video is for you. Here's the thing, the clock is ticking and there are deadlines that you cannot afford to miss. Stick with me because in the next few minutes, I'll show you what's happening right now with student loans, the 3 debt personas that I see people commonly falling into, how interest really works, and finally, how to use all of this information to create a strategy that will work for you. All right, so let me get you up to speed. I've posted many videos on student loans and you can watch them all here. But as a quick refresher, about 8 million borrowers have been in a safe forbearance and haven't had to make a student loan payment for the last year. No payment, no interest. But as of August 1st, 2025, interest is back. Payments are still paused, but under the SAVE plan, it's coming to a close by July 1st, 2028, if not sooner, under the One Big Beautiful Bill Act. And here are a few more dates that you cannot miss. July 1st, 2026. If you have Parent Plus loans, you must consolidate by this date in order to make the income-based repayment option accessible to you. Thereafter, you'll have limited options that will not be based on your income. Also on July 1st, 2026, that marks the date of new loans. So if you consolidate after this date and you effectively make a new consolidated loan, or you take out any new borrower debt by this date, you will have to enroll in the RAP plan. That is the Repayment Assistance Plan put out by the Trump administration. So if you are a current borrower and you're thinking maybe doing a Master's Public Health or an MBA, I would say if all of your loans are before July 1st, 2026, you likely want to think twice about enrolling in that program because that will limit your student loan options moving forward. July 1st, 2028. This is when all the other plans outside of the standard repayment option, repayment assistant plan, and income-based repayment sunset. So that means that you'll have only now 3 options for your student loan repayment. And if you are a current medical student, then you are likely grandfathered in. They will allow you to complete your education under the terms of your original note. You can still access Grad Plus loans and you do not have the $200,000 professional cap that the One Big Beautiful Bill Act has placed on professional degrees. So there you have it. These deadlines matter. And if you miss them, then you will miss options. Don't delay. Focus on what you can do and make a decision so that these dates don't dictate what you have to do. It allows for you to choose. How are people handling all of this information? How do people typically handle their student loans? And there are 3 personas that I commonly see when I'm talking to individuals and teaching them about debt. The first persona is the avoidant persona. This is a person who's not looking at their loans at all. They're like, oh, well, these loans are gonna die with me. The emails go to spam, but the interest, it doesn't care about your negligence or your avoidance. So the interest is going to keep growing despite your lack of awareness. The second mindset is the minimum mindset. This is a person that is paying just enough to say that they're doing something, but not really doing much at all. It's like you're on a treadmill, but there's no movement because your payments don't even touch the interest. And the last one is the wishful thinker. This is a person that is betting on future raise or governmental forgiveness. They don't have a plan. They just hope that at one point in time, their student loans will be gone. And here's the truth. We've all been one of these personas before. But the reason why this matters most is because it comes down to how much you're going to pay over time through interest accumulation. So let's actually talk about how interest works. Federal student loan interest is actually different from credit card interest, meaning that the interest is not automatically added to the principal every single month. See, your student loans, that original amount that you took out, that is called your principal. You have your annual interest rate that accumulates in a different bucket. let's say. The principal and the interest are held in separate buckets until you do something to make them capitalize, combine them all into one bucket. So your principal basically is the amount that you originally borrowed, and your interest is your interest. So the interest grows on top of that every single day. And when you do something with your student loans, when you consolidate them, when you move them from the save plan into another plan, that typically causes them to capitalize. It causes that principal and the interest to mix in one bucket. And when you do that, you're now adding your interest to your principal. That means that your interest is growing interest on its interest. But when you keep them separate, your payment goes to the interest first and may or may not touch the principal. So you take your annual interest rate, you divide that by 365, and that will give you your daily interest rate. Now you're going to take that daily interest rate times that principal amount, and that will tell you how much interest is going to accrue on a daily basis. That interest continues to accumulate in the interest bucket, and when you make a payment, the payment goes towards paying down your interest first versus your principal. Now, where people get into trouble is that their payments don't cover the interest. Let's say that you have the average amount of medical student loan debt. For 2024, that was $205,000, and your interest rate is 6.8%. So 6.8% divided by 365 gives you 0.018%. Let's take that 0.018% and let's times that by $205,000. That gives you the amount of interest that will accumulate in your student loans daily. So that is $36.90 daily that is accumulating for your student loan. Now, if we times that by 30, which means this is your monthly interest accrual, that is $1,107 that your student loans accrue in interest every single month. Let's say that you are on an income-driven repayment option and your payment is $200 a month. If you apply that $200 to the interest first, you still have $907 of interest that has not been paid off. And every single month, you have that deficit. So this is how the total balance continues to grow and grow and grow because their payments don't touch the principal. When I was paying back my student loans, I graduated with $131,000 from medical school. And when I finished residency 3 years later with me making extra payments, I had $135,000 of student loan debt. That's because my payments didn't even touch the interest, so the interest continued to accumulate. This is what happens when we're paying off our student loans. And this is why it is imperative that you get a strategy that is going to work for you. One of the best things that I like about the RAP plan, it doesn't allow for this negative amortization. What I mean by that is that it doesn't allow your student loan interest to continue to grow. If that $200 is not touching the $1,100 of interest, the government under the RAP plan would forgive that deficit, would forgive that $900. And if it's not touching the principal, they're going to deduct $50 off of the principal. So your principal is going to be lower every single month, at least by $50 if your payment doesn't cover the interest. So when you are thinking about creating your student loan strategy, you must take these things into account. And it is also imperative that you understand what is your adjusted gross income, because whether you are enrolling in the income-based repayment option or whether you are enrolling in RAP, they are both going to be based on your adjusted gross income. Now, income-based repayment option is actually based on your discretionary income. So your discretionary income basically gives you a little bit more of a bonus based on the federal poverty line deduction. So the discretionary income is your adjusted gross income minus that federal poverty line deduction that you'll get for your family size. So if you're doing a head-to-head comparison of a new income-based repayment, meaning that you don't have any new debt after 2014, or this new RAP plan, the income-based repayment option is going to win, except for one rule. After 3 years, it does not subsidize any unpaid interest. So you have to take that into account. Student loans can be completely complicated, and hopefully I have not confused you. It is really important that you understand how student loan interest works, because the interest is accruing daily. It's not just an annual, it's a daily accumulation. And therefore, you want to understand how much is accumulating daily so that you can pay that off quicker if that is your goal. That's why your repayment plan isn't just about lowering your bill. It's about whether your payments are moving you forward or not. And now that brings us to the framework. These are 3 considerations that you need in order to break into your key strategy for your student loans. So the first thing to think about is to decide whether you desire forgiveness or not, because that is going to change the strategy. My advice for this is, do you have federal loans or private loans? Because private loans are not going to be forgiven under the federal government. There are other types of repayment plans and forgiveness that might be institutional or even state forgiveness options for your private student loan. Now, once you decide whether you want forgiveness or not, then you have to understand your financial standing. And that is your financial standing, not just for today, but also for tomorrow. You want to look at your emergency fund. Do you have 3 to 6 months in your emergency fund? Also, understanding your cash flow. Can you actually afford to pay the amount that you might have to pay under income-based repayment versus what you may have to pay under RAP? And lastly is your credit score, because this will affect your ability to refinance your student loans if desired. And the last factor that I want you to consider is your filing status. Income-driven repayments are based on your income. So filing jointly versus filing separately can swing the bill from $100 to maybe $300, $400 plus dollars, depending on your partner's income. So this is really important to talk to a tax accountant about, because when you do merit filing separately, you lose access to some deductions and tax credits that might be available to you. And honestly, you need to pay attention to this, because there might be other opportunities available to you that you may not be aware of. So I would always encourage you to, every 6 months, as you're thinking about your student loan plan, evaluate these 3 things. And if forgiveness maybe is something that you're considering now, reevaluate to see if that's still working for you and your lifestyle. Also, if you're desiring forgiveness, then you might want to seek what are the available opportunities that can help me to accelerate that forgiveness. And speaking of which, I learned of one in the news today. So Newsweek just reported Maryland residents have until September 15th to apply for this Maryland Resident Debt Relief Credit. And it's worth up to $5,000 for the 2025 tax season. Now, let's bring it all together. So if you are the avoidant personality, the first thing that I want you to do is to get your login and actually take a look at your student loans. You want to write down, what are all of your student loans? What are their interest rates? Are they private or are they federal? Then ask yourself, do you want forgiveness or not? And think about, what will my payments be under IBR versus what will my payments be under RAP? Because remember, although you are in the save forbearance and payments are not due, these months do not count towards forgiveness. So you're literally just delaying and allowing that interest to accumulate. If you're the person where you're like, I'm just gonna do the minimum and at least I'm doing something, you are already making payments, but they're not strategic. I want you to actually sit down and run the numbers. Look at what your payments will be under the RAP plan and what they will be under the income-based repayment option. Would a different plan actually get you there faster? Look at your cash flow. Do you have a significant amount of money left over every month that if you have decided to pay off your loans, then you can decrease the amount that you pay over time by eliminating the interest from ballooning out of control? Stop just making a payment and make a strategic payment that aligns with your goals instead. And if you're a wishful thinker, then it is time to move on. It is time for you to remember your math, because the government is showing us that forgiveness may not be as likely or as easy as it once was. So I want you to take some time to map out your earning potential and understand who you are and what you desire. If you decide, you can pay off your student loans aggressively as long as that debt to income ratio is at 1.5 or less, meaning the amount of money that you spend towards your debt divided by your gross income is 1.5 or less. So regardless of who you are, the avoidant, the minimum mindset, or the wishful thinker, a plan is going to be your best bet. And you don't have time to delay because you have deadlines that you have to achieve. You don't have time to delay because that interest is accumulating. So making a strategic plan focusing on those three factors, forgiveness, your financial standing, and your tax filing status, will help you to know what your plan should be today and how that plan will change later on. If you have any questions, then feel free to put them in the comments. I will answer your specific question and do the calculations for you, but only when you put them in the comments. And remember, this is for educational and entertainment purposes only. So you want to do your own research as well. But I am here to support you because I understand how nuanced and complicated this can be. And if you learned something today, then I want you to give this video a thumbs up and hit that subscribe button. And please, please, please share this with your friends. I am almost there to being monetized. And if you share this with at least 3 or 4 of your friends, you will help me to get there. I literally need only 100 hours more. So watch my next YouTube video all the way through. Leave a comment. Help me to reach this goal if I have helped you. My goal is to spread financial education in a way that it feels digestible, meaningful, and to help you to achieve your financial goals, because money is just a tool that helps us to get to financial wellness, and my goal is to help you to achieve that. So please, please, please share with your friend, leave a comment, give this video a thumbs up, and help me to reach my goal. I want to thank you in advance, and I'll see you in the next video. Bye-bye.